somewhere between $50 and $60 an ounce. Silver is sitting on one of the strangest setups in its entire trading history, and almost nobody is talking about it the right way. Most coverage treats this as just another commodity story, a number that moves up and down on a chart. But if you strip away the noise and look at what's actually happening beneath the surface, silver right now looks less like a passing rally and more like a market that has permanently changed character. To understand why, you have to go back to where this really started, because the story didn't begin this year. It began with a slow, almost boring grind that most investors ignored completely. At the start of 2025, silver was trading in the high 20s, a price so unremarkable that it barely made headlines. Over the following 12 months, it didn't just tick higher. It surged past the long-standing resistance near $35, then tore through the historic $50 ceiling, a level that had only been touched twice before in modern history. The first time was during the Hunt brothers' attempt to corner the silver market in 1980. The second was the speculative run of 2011. Both times, silver hit that ceiling and immediately collapsed, unable to hold the gains. This time was different. Silver didn't just touch 50 and retreat. It broke through it, kept climbing, and finished 2025 above $70 an ounce, delivering its strongest annual performance since the late 1970s. Then came January of this year, when the rally accelerated into something almost disorienting. Silver pushed above $100 for the first time ever, a level that had always been treated as a distant, almost theoretical target. It didn't stop there. Within weeks, the metal touched an intraday high above $120. For a market that spent decades trading in a tight, predictable range, that kind of move was jarring. And true to silver's volatile nature, the euphoria didn't last. Profit-taking set in, tariff tensions eased slightly, and the dollar found some strength, triggering one of the sharpest corrections the metal has seen in decades. Silver fell hard, eventually working its way down into the 50s before stabilizing. That brings us to where things stand today. As of this week, silver is trading in the high 50s to low 60s, still up dramatically from where it started 2025, but well off its January peak. The gold to silver ratio, a number analysts watch closely to judge whether silver is cheap or expensive relative to gold, has fallen below 70, a level not seen in years. When that ratio compresses, it typically signals that silver is outperforming gold, catching up after years of being the overlooked half of the precious metals trade. Right now, silver is doing exactly that. And the question every serious investor is asking is whether this is the beginning of another leg higher or simply a pause before another sharp pullback. To answer that, you need to look at why silver has behaved this way in the first place, because unlike some rallies that are driven by a single headline, this one is being pushed by several forces that are all pulling in the same direction at once. The first and most talked about is monetary. When real interest rates turn negative, meaning inflation is running hotter than the return investors get from holding cash or bonds, precious metals become one of the few assets that can preserve purchasing power. Gold has traditionally been the go-to hedge in these environments, and central banks around the world have been accumulating it for years as they look to reduce their dependence on the US dollar. What's notable about this cycle is that some central banks have gone a step further, allocating meaningful reserves towards silver as well, something that historically has been rare. But that's only part of the story, because silver isn't just a monetary metal the way gold is. It's also an industrial one, and that dual identity is exactly what makes this current setup so unusual. Roughly half of all silver demand comes not from investors or jewelers, but from manufacturing. Silver is used in solar panels, electric vehicles, semiconductors, and a growing list of technologies tied to artificial intelligence infrastructure and data centers. As those industries have expanded, so has the physical demand for the metal, and unlike gold, which is mostly held rather than consumed, a significant portion of silver used industrially is gone for good, embedded into products that are never melted back down. That creates a structural pull on supply that doesn't exist in the same way for gold. Here's where things become more interesting. The silver market has now posted a supply deficit for 6 consecutive years, according to industry estimates, meaning the world has been consuming more silver than mining and recycling combined has been able to produce. Deficits of this size and duration are unusual for any commodity, let alone one that trades with the kind of volatility silver is known for. When you combine a multi-year supply shortfall with surging investment demand and central banks quietly building positions, you get a market where relatively modest additional buying can push prices dramatically, simply because there isn't much slack in the system to absorb it. It's worth pausing on how this physical market actually functions, because a lot of the confusion around silver comes from not understanding where prices are actually set. Most of the benchmark pricing the world relies on comes out of 2 places: the London Bullion Market Association, which oversees the over-the-counter trading of physical bars between banks and refiners, and COMEX in New York, where silver futures contracts trade almost around the clock. These two markets are deeply connected, and when there's a large gap between what's happening in paper futures contracts and what's happening in physical bar availability, you sometimes see unusual stress show up in the form of tight lease rates or delivery delays. That kind of friction has appeared periodically over the past year, and it's one of the clearer signs that this rally isn't purely speculative paper trading. It's being reinforced by genuine tightness in physical supply. Most people overlook one important detail when they look at silver's price chart, and it's this: the market is far smaller than most investors assume. The total value of all the investment-grade silver in the world is a fraction of the gold market, which itself is a fraction of the global bond and equity markets. That small size cuts both ways. It means that when large pools of capital decide to rotate even a modest percentage of their holdings into silver, the price impact can be outsized. It also means the moves can reverse just as sharply when sentiment shifts, which is exactly what happened after the January spike. Silver's history is full of these dramatic surges followed by equally dramatic retracements, and anyone studying this market needs to respect that pattern rather than assume the metal simply climbs in a straight line. That's part of why the current period of consolidation matters so much. After the run to $120 and the subsequent pullback, silver has spent recent months trading in a wide range, testing support in the low 70s before this year's geopolitical shocks pushed it down further into the 50s. Analysts tracking the technical picture have pointed to resistance clustered in the low 80s, a zone that capped previous rallies in late 2025. A decisive move above that level on strong volume is the kind of signal chart-based traders look for before concluding that the bull trend has resumed. Until that happens, this consolidation phase can reasonably be read either as healthy basing before another advance or as the start of a longer, more painful correction. Nobody can say with certainty which outcome will unfold, and it's worth being skeptical of anyone who claims otherwise. To understand why this matters beyond the chart, we need to look deeper at the geopolitical backdrop that's been shaping sentiment all year. Renewed conflict involving Iran, tension in the Middle East affecting shipping routes through the Strait of Hormuz, and ongoing trade friction between major economies have all added a layer of safe haven demand on top of silver's existing industrial and monetary drivers. When investors grow nervous about global stability, they often rotate into hard assets, and silver, despite being more volatile than gold, has benefited from that flight to safety. At the same time, prolonged conflict raises the risk of higher energy prices and stickier inflation, which complicates the path for central bank interest rate decisions. Markets are currently watching the Federal Reserve closely, with many expecting policymakers to hold rates steady in the near term rather than risk further disruption. Because gold and silver are priced in dollars and tend to respond inversely to real interest rates, any signal from the Fed carries outsized weight for where these metals go next. This is where opinions among professional analysts start to diverge sharply, and it's worth being clear that these are opinions, not guarantees. Some major banks have issued price targets well above where silver trades today, pointing to the historically tight relationship between gold and silver prices, and arguing that if that ratio continues compressing toward its long-term average, silver could have substantial room to run even from current levels. Other analysts and prominent commentators in the precious metals space have gone further, framing silver as dramatically undervalued once you adjust for decades of inflation, and suggesting the metal could eventually reach levels that would have sounded absurd just a few years ago. On the other side, more cautious voices point out that silver has a long history of overshooting to the upside and then giving back a large portion of those gains, sometimes for years afterward, as happened following both 1980 and 2011. They argue that chasing the metal after a move this large carries real risk, regardless of how compelling the long-term supply story sounds. It's also worth revisiting those two historical spikes in more detail, because the parallels and differences tell you a lot about what could unfold from here. In January of 1980, silver reached roughly $48 an ounce, driven largely by an attempt from a small group of wealthy investors to corner the physical market. The moment that buying pressure stopped, the price cratered, falling back to around $11 within a few months and staying depressed for the better part of 2 decades. That collapse wasn't really about industrial demand or monetary policy. It was about a concentrated speculative position unwinding all at once. The 2011 episode was different in cause but similar in outcome. That rally was fueled largely by fears around the global financial crisis, aggressive central bank stimulus, and a broader flight into hard assets, and it also reversed hard once those fears eased and interest rates began normalizing. What's notable about the current cycle is that neither of those specific triggers is really driving it. This isn't a cornering attempt, and it isn't purely a fear trade tied to one crisis. It's a combination of structural supply deficits that have persisted for 6 years running, industrial demand tied to genuinely expanding sectors like solar energy, electric vehicles, and computing infrastructure, and a monetary backdrop where several major economies are dealing with persistent inflation pressure. At the same time, global conflict is elevating uncertainty. That doesn't mean history can't repeat itself. Speculative excess can build on top of any of these fundamentals, but it does mean the comparison to 1980 and 2011 is useful for understanding volatility rather than assuming an identical outcome is guaranteed. Both perspectives deserve serious consideration because both are grounded in real historical patterns. The bullish case rests on genuine structural factors, persistent deficits, rising industrial consumption tied to energy transition and computing infrastructure, and renewed interest from institutions that historically ignored silver altogether. The cautious case rests on an equally real pattern of silver's tendency to attract speculative excess near major round number milestones, only to correct sharply once that enthusiasm fades. Rather than picking a side, it's worth understanding that both dynamics can be true simultaneously. A market can have powerful long-term tailwinds and still experience brutal multi-year drawdowns along the way. Anyone approaching silver purely as a short-term trade is playing a very different game than someone viewing it as a multi-year structural position, and conflating the two is where a lot of investors get into trouble. That brings us to another critical question that doesn't get enough attention: what actually happens to the industrial side of this equation if prices keep climbing? Higher silver prices don't just affect investors, they ripple through entire supply chains. Solar panel manufacturers, for instance, have been actively working to reduce the amount of silver used per panel because at elevated prices, silver has become a meaningful input cost. If that substitution and thrifting trend accelerates, it could eventually soften industrial demand growth, even as broader adoption of solar technology continues to expand. Jewelry demand tells a similar story. In markets like India, which have historically been massive consumers of physical silver, high prices have already begun curbing purchases, with demand there projected to decline for a second straight year. China, interestingly, has moved in the opposite direction, with growing appetite for silver-based jewelry products even as prices rise, showing that demand responses to price aren't uniform across regions or cultures. For anyone thinking about how to approach silver from here, a few practical points are worth keeping in mind, understanding that none of this constitutes personalized financial advice, and everyone's circumstances, risk tolerance, and time horizon are different. First, volatility is not a bug in this market, it's a defining feature. Silver routinely moves several times faster than gold in both directions, which means position sizing matters enormously. A move that would be a rounding error for gold can represent a significant swing for silver. Second, the distinction between owning physical metal exchange, traded products, mining equities, and futures contracts matters a great deal because each carries different risks, costs, and correlations to the underlying spot price. Mining stocks, for example, can offer leveraged exposure to rising prices, but they also carry company-specific risks around production costs, geopolitics in mining jurisdictions, and management decisions that have nothing to do with the price of silver itself. Third, and perhaps most important, is recognizing where we are in this cycle relative to history. Silver has already delivered one of its most powerful moves in decades. That doesn't mean the move is over, and it doesn't mean it's about to reverse. It means the easy, obvious phase of this trade, if there was one, has likely already happened. What comes next will probably be more complicated, more news-dependent, and more prone to sharp swings in both directions as the market tries to figure out whether $100 silver was a peak, a pause, or simply a stepping stone. What makes this moment genuinely fascinating is that silver sits at the intersection of so many major economic narratives happening at once. It's tied to the future of clean energy and semiconductor manufacturing. It's tied to central bank policy and the ongoing question of dollar dominance. It's tied to geopolitical stability in a world that feels considerably less stable than it did just a few years ago. And it's tied to a supply picture that, unlike a lot of commodities, cannot be quickly fixed by simply opening new mines, since developing new silver production takes years and enormous capital investment. That combination of factors is rare, and it's part of why so many serious market participants are watching this metal so closely right now, even if they disagree completely on where the price goes from here. None of this guarantees any particular outcome, and it's worth being genuinely skeptical of anyone online promising you know exactly what silver will do next. What you can do is understand the forces at play, watch the key levels that technical analysts are tracking, pay attention to what the Federal Reserve does with interest rates in the coming months, and think critically about how a position in silver, if you choose to take one, fits into your broader financial picture rather than reacting emotionally to a headline number. Markets like this reward patience and clear thinking far more than they reward excitement. If you found this breakdown useful, It would mean a lot if you hit like on this video and shared it with someone who's been asking questions about where gold and silver might be headed. I genuinely like to know what you think happens next. So drop a comment with your own take, whether you're in the bullish camp, the cautious camp, or somewhere in between. And if you want more breakdowns like this as this story develops, go ahead and subscribe and turn on notifications, because with everything happening in this market right now, this is very unlikely to be the last time we talk about silver.